Hi everybody, it's AJ speaking. Welcome back to my series on Rivian. This is part 3. In part 2 we finished off discussing some of the upside risk factors for Rivian, but we should also briefly discuss some of the major downside risk factors, and we'll touch on those later in the presentation again when we discuss the respective financial disclosure line items. So a very big risk to Rivian is that the new US administration negatively affects the emission certificates trading in the United States. So any kind of demand impact for such CO2 emissions certificates, or for short credit sales, would have a major profit impact on Rivian. The reason why the impact on Rivian is actually much more pronounced than it would be for Tesla is because Rivian is extremely US concentrated. Rivian's market is essentially the United States and Canada, and there's virtually nothing beyond that. And the vast majority of Rivian's global market is comprised of just the US. So it's highly concentrated, while Tesla has not only a globally diversified auto business, and in fact Tesla's largest auto market is now China, but on top of that Tesla has a quickly growing energies business, has a much larger services and other business. Then of course there are prospects of becoming a robotics leader, FSD, etc. There are a lot of things that make Tesla like day and night differently positioned than Rivian in that regard. So the risk, the relative risk to Tesla and Rivian is absolutely not comparable. For Rivian, this is a really big deal. For Tesla, I would call it mostly a bump in the road in the short or medium term. Because I'd like to point out, Tesla's credits income is not just driven by the US, because such schemes exist widely in Europe, but also even in China. So Tesla's credits line wouldn't go away, probably not even half, even if the US axed most or all of the credit sales. But this video is not about Tesla, but the reason I use Tesla because it's the best analog in many ways for a number of these things. Obviously, because Rivian, US automaker, Tesla, US automaker, pure play EV maker, Tesla pure play EV maker. So Tesla is the obvious comparison. So the other major effect, and which I've seen not discussed that much, is actually the IRA manufacturing credit. So EV makers making batteries and electric vehicles in the United States, they get actually quite substantial manufacturing subsidies. And if that one was to go away, that would also be a major blow to Rivian's automotive gross profit, because it would increase costs of production. Since Rivian can take these subsidies and offset some of the production cost. So the production cost that you see in the financial disclosure is actually reduced through these manufacturing credits. The other very big item is that Rivian loses this very large Department of Energy loan of 6.6 billion. So this forecast assumes Rivian fully gets this loan, and in a timely manner for increasing production capacity for the second factory. But even if Rivian gets the full loan, there are some other risk factors. It's conceivable that there might be some modifications to this loan under the new administration. A lot of people talked about the why the US taxpayer is not participating in the upside of companies. It clearly helped to grow, and there's an argument the US taxpayer should have some equity share. So if there was the implementation of an equity portion into Rivian in exchange for getting this very large loan, then dilution in Rivian would substantially increase, just because of the scale of the look. If the government just asked Rivian to get like a 10% stake in Rivian in exchange for getting this loan, Rivian would gladly take it. I can tell you that. And the reason is that Rivian is already very highly levered. Rivian has has about 4.4 billion in debt, and the debt over the forecast will go up because the forecast also accounts for the announced VW debt injection, and we'll discuss this later. So Rivian said it's going to go up, and the problem is Rivian's balance sheet total equity is, because of negative free cash flow, consistently decreasing, and this is driving up another key credit profile metric, which is debt leverage. And if you want to get a loan from a bank, or want to issue a bond to access reasonable priced debt in the market, you can't have too much leverage. Otherwise, people will ask a huge risk premium. And right now, I think, given the large leverage and also the loss-making outlook, banks would charge incredibly high rates, and also a bond would be rated like junk, and would also carry a very high coupon. So that is not really an option for Rivian anymore, because the leverage has become just too high. So Rivian really needs that government loan. In addition, because the only alternative would be another capital raise, and given Rivian's very large capital needs, as you will see later in its presentations, relative to its current market value, the capital raise would have to be quite substantial. So this entire forecast is built on getting this DOE loan without any significant modifications, but this is a huge risk factor. So any investor, please pay attention to any news on that item, because that has a major impact on this forecast, and it's only negative, I can tell you. So with that, we already kind of touched on free cash flow. So free cash flow, just a really quick recap. So free cash flow is simply your operating cash flow less what you spend on CapEx. CapEx is basically all your investments in tooling, equipment, buildings, so all the long-term assets that help you make the product. And you can see here Rivian's CapEx spend, there was just over $1 billion in 2023, 1.1 billion in 2024, slight increase, and then there's a material increase for 2025. This is based on the low end of Rivian's guided range. So Rivian is guiding for 1.6 to 1.7 billion in 2025. So the forecast, as I said before, has an optimism bias. And whenever Rivian provides these kinds of metrics, the Rivian has like an optimistic view on it, and that's why we only assume 1.6 billion, but keep in mind it could be higher, slightly higher. And then Rivian also told us that they expect a year-on-year increase in CapEx spend from the 2025 level, and that's why you see this increase, and this is kind of expected because Rivian launches the R2 platform, so there a lot of tooling, and so in the first quarter of 2026, a lot of tooling will arrive at the new factory. Bills are basically being paid, and lots of things like that. You can always see this with Tesla when they put up a new production line. A lot of stuff arrives in the last few months prior to launch of a new product. So that's why it's completely natural to see that this spike. So the forecast assumes, as you can see over here, a 20% increase, but keep in mind 20% looks like a lot, because we are assuming the low end of the guided range. If we use the higher end, for instance, the 1.7 billion, or the midpoint, for example, from the midpoint 1.65 billion, this would only be a 16% increase. So anyways, this might look to you as minutia, but still has a meaningful impact on free cash flow, which, as you can see, is massively negative. And a big driver is CapEx, but you can also see that the by far biggest driver is operating cash flow. And because the video already kind of got long, I stop here and we'll discuss operating cash flow in the next part 4. So thanks for listening, and see you in the next one.